So this video, we're picking it right back up from where we left off in the last video on our traditional monetary policy tools. In the last video we looked at the primary goal of monetary policy, which is to decrease the interest rate to encourage spending from consumers and businesses. And to do that, we looked at two tools the Federal Reserve uses, which are directly decreasing the discount rate, the rate at which banks can borrow from the Fed, and then we looked at reducing the reserve requirements so that banks can use more of their reserves to make loans. And so that's where we left it off, and we have one more traditional tool left, which are the open market operations. And so we're going to pick it up from here and see to what extent the Federal Reserve is able to use these tools to affect monetary policy a little bit in the past and currently, and their ability to continue using them in this recession that we're facing here due to coronavirus. Okay, so let's jump in. Open market operations. Again, this is the primary monetary policy tool of the Federal Reserve. And what they're going to be doing is buying treasury securities from the public in order to increase the money supply. As the money supply increases, we'll see the interest rate goes down. And the interest rate in particular here that open market operations is affecting is the federal funds rate. So the discount rate from before, that's different. The discount rate is the rate at which banks can borrow from the Fed. And the federal funds rate is the rate at which banks can borrow from each other. So the rate at which banks can borrow from each other. Okay, and this would widely be considered the primary, or maybe the baseline, interest rate in the economy. So if the federal funds rate goes up, then mortgage rates will go up, car loan rates will go up, and vice versa. So this is kind of the toggle, the lever that controls all of the interest rates throughout the economy. And so this is an important one, and this is why open market operations are one of the most widely used monetary policy tools. Okay, so to do this, the Federal Reserve is buying government debt, treasury bills, within the financial markets. So individual investors can have these treasury bills, their short-term bonds. Individual investors, large investors, investment banks, and so on, and even foreign countries have these bonds. So we have the Federal Reserve. Again, let's draw a little, let's see, Corinthian columns here. And we have the Federal Reserve. Oops, Fed. So here's the Federal Reserve. They have a bunch of money in their vaults. And now we have some institutional investors on Wall Street, and then we have some normal people, normal investors, and even potentially some foreign countries. But these people, these investors, they own some bonds. Actually, let's move these people over. So this is a U.S. government bond. So they own a couple. The individuals own a couple of these government bonds, and so what the Fed is doing is they're just buying the bonds. So the bonds come to the Fed. The Fed's assets increase, and ultimately the Fed is paying for it with dollars, and so money is going out into the public to investment banks, regular commercial banks, individual investors, but ultimately the Fed is sending money out into the economy, increasing the money supply, and then we're gonna kind of show again graphically how that's going to be beneficial. But ultimately, again, it's coming down to interest rates, affecting consumption and investment. Okay, so to do that, we're going to use a little bit of a supply and demand model. So taking you back, and what we're going to do here is do the supply and demand for money. Okay, and so when we're talking about that, the price of money is just, like I mentioned before, the interest rate. And in particular here, we're going to be thinking about the federal funds rate. And it doesn't actually matter, it doesn't make a difference, but we're going to simplify the supply for money. Because the supply in the short term is fixed, then in the short term, the supply curve is vertical, or in economic terms, perfectly inelastic. That'll just simplify our graph a little bit. Okay, but again, the price is the interest rate. We're going to call that R. And in our money market, we have the demand for money. Demand. And let's go with, it doesn't matter where, the supply, the money supply. So the quantity or the money supply. Okay, and so here's S0. Demand, we're not gonna mess with the demand. But this is where we start. And so based on that, we have our equilibrium interest rate, R0 star, and the equilibrium initial money supply. Okay, M0 star. Now, what's happening? Again, the Fed is buying the bonds, and that's ultimately increasing the money supply within the economy. So increase in the money supply means a rightward shift. Let's make it green. Okay, so we've increased the money supply in the economy. And what's that do? Equilibrium interest rate falls. Okay, and so let's call this a 1.75%. And and R1 star is, I guess we'll call that 1%. Although actually right now it's down here in real life. The target rate is between 0. It's a range, but it's between 0 and 0.25%. And so, but ultimately, what's happening? Interest rate is going down. Well, I'm going to write this down below, but interest rate is going down, so cost of borrowing decreases. So we see a bunch more borrowing and lending. Okay, so the result here, the policy implication, is reiterating what we talked about before, but ultimately money supply increases. The federal funds rate falls, and then that's followed by other interest rates around the economy. So for borrowing cars and houses and business loans and so on, cost of borrowing has decreased. Cost of borrowing has decreased. So consumption and investment increase. And again, finally, GDP increases and we avoid economic collapse is the idea. Okay, and so that's the idea behind open market operations. And you can see we've been pretty active in that realm as well. So this graph is showing us two things. One, like I said, this is an indirect it's an indirect method. The federal funds or the Federal Reserve is just setting a target rate with a range of 0.25%. So here, the range was 0.25 to 0.5. Most recently, at its most recent peak, the range was 2.25 to 2.5. Okay, and then actually starting from the end of last year, which by the way, we were seeing some possible cracks in the economy even before all of this coronavirus happened. And in particular, with the trade war at the end of last year, manufacturing was down. A lot of other countries around the world were hurting. Germany was a big one. And so we had economic fissures even before this happened, and the Federal Reserve started decreasing the interest rate a bit even before all of this coronavirus. But as you can see, recently here, the Federal Reserve has dropped it all the way down to its lowest possible level, 0 to 0.25%, which is the lowest it could possibly go without going negative, which the Federal Reserve has indicated that they're not going to have negative interest rates. And that's something I'm not going to talk about in this video. And negative interest rates are a thing. Some other countries around the world have done that recently. Japan, notably, European Central Bank, Sweden. But that's for a different topic. Actually, that's something I talk about in money and banking class and in intermediate macroeconomics. So and I've already discussed it in those classes. So anyway, negative interest rates are a thing. We're not going to discuss it here. But again, they're just setting the target. So this blue line are their target rates, and the red line is the actual rate. So ultimately, the bond market for these short-term government treasuries is a market, and it has actual prices. But through its buying, of these bonds, the Federal Reserve, as you can see, if they target a certain rate, then that interest rate is going to fall within that rate. So you can see the Federal Reserve, although it's indirect, is very effective at keeping that target interest rate approximately within their range. So most common monetary policy tool, but now we've reached our limit. We're at 0. We won't go any lower. And so this traditional monetary policy tool won't be able to be used going forward. Okay, and so that actually leads us to the last thing, which is, what are we going to do with traditional monetary policy in this public health crisis turned economic, or in addition to an economic crisis as a result. And so at this point, discount rate is 0.25%, pretty much nearly at its limit. So adjusting the discount rate going forward is not going to have much effect on the economy. It's almost as low as it gets. Reserve requirements are at 0%, and again, the lower the better as far as expansionary monetary policy. So reserve requirements are not going to be effective, and our current federal funds rate is also at its lower limit, 0.25%. So open market operations are also not effective in this current crisis. And this last thing I want to show you here is that is a graph of the federal funds rate from the last 50 years. And again, the gray bars here are recessions. And again, during recessions, we want to decrease the interest rate to encourage all of this borrowing. But I just want to point out the use of monetary policy to affect the federal funds rate over all of these last 1, 2, 3, 4, 5, 6, 7 recessions. Here we're up about close to 9%, and at the bottom of that we're down to, say, about 3 or 4. Let's call it 4. So during this recession, we decreased by about 5%. During this recession, we started federal funds rate up around 11, down to about 6. So again, 5%. Here, 17 down to 10, 7%. Bottom of that, we're down to about 1, 5%. And finally, the Great Recession from the housing crisis, starting at 5% and going down to 0. So again, 5%. So all of these recessions for the last 50 years, we had a 5% or more drop in the interest rate. Where did we start this recession? We were starting here at about 2%. And so we don't have 5% to go. That's not possible. And already, even at the very beginning of the fallout from all of this, we're already at the 0% mark, and we're only a little over a month, maybe a couple months into the fallout here from coronavirus. So we don't have 5% to go. And what does that mean? That means traditional monetary policy is not going to work to help bring us out of this recession, as it has helped us for the last 50 years. So instead, what are the solutions? Well, we have the possibility of non-traditional monetary policy, or, well, and actually, not or, and fiscal policy. Okay, which is all of the stuff coming out of Congress. So the stimulus checks, the business loans, bailouts, and so on and so forth. Anything coming from Congress, we can be thinking of that as a fiscal policy response. So unlike not that we didn't have fiscal policy responses in other recessions. Actually, we had a big one, $800 billion, which is actually small compared to what we've done so far here, $2 trillion plus. already. We had a big 800 billion stimulus package in the Great Recession. So we've had fiscal policy in the past as well, but that's really going to need to be a main driver for coming out of the recession that we're in now from coronavirus. As well as some non-traditional monetary policy tools, which the Fed has already started doing. I suspect some of that will continue, but again, really more than before, it's probably going to be more of a fiscal policy response in this recession compared to previous. Okay, and so both of these topics are going to be different videos coming up later, but that'll do it for now. Hopefully you found this interesting and informative. And so yeah, keep an eye out for the next videos, and thanks for watching.